Palantir Technologies has been the subject of major discussion in the financial world recently after several analysts updated their outlooks and price targets for the company. 3 different analysts have provided fresh valuations, each bringing their own perspective to the table, and this mix of opinions paints a fascinating picture for anyone following the stock. The first notable update came from Chris Versace, a veteran of more than 30 years on Wall Street and the overseer of the Street Pros portfolio. Versace announced that he is raising his price target for Palantir from $160 to $190 after taking a deep dive into the company's most recent earnings report. His recommendation is to stockpile the shares, which in simpler terms means he encourages investors to buy during pullbacks or after confirming the strength of technical support levels. This type of recommendation often signals that the analyst sees long-term potential, but recognizes that buying at a discount improves the risk-to-reward balance. Versace's optimism is largely tied to the company's impressive commercial performance in the United States. He highlighted that the total value of United States commercial contracts has surged by over 222% on a year-over-year basis, reaching a remarkable $843 million. Additionally, the remaining deal value for United States commercial operations rose by over 145% year-over-year and by over 20% compared to the previous quarter, climbing to $2,800 million. These figures demonstrate that Palantir is making substantial headway in the private sector, countering the outdated belief that the company's primary strength lies in government contracts rather than commercial business. It is worth noting that Versace does not believe United States government revenue growth has slowed in any meaningful way. Instead, he sees Palantir as one of several companies, alongside names like ServiceNow, that is benefiting significantly from the wave of artificial intelligence adoption across enterprises. This shift is driving a new phase of growth for the company as businesses across industries seek ways to use artificial intelligence to increase efficiency and improve decision-making processes. Another important point Versace mentioned is Palantir's growing operational efficiency. Adjusted operating margins are expected to reach 47% in the second half of 2025, an increase from 45% in the first half of the year and up from approximately 37% 1 year earlier. This steady improvement in profitability suggests that the company is not only increasing its revenue, but also getting better at turning that revenue into earnings. Versace went so far as to say that margins in 2026 could exceed the company's current goal of 46%, which would signal even stronger profitability in the years ahead. Given these trends, Versace believes that other analysts may soon revise their earnings forecasts for 2026 upward, and that higher earnings expectations could lead to new price target increases. However, while Versace's target of $190 is bullish, the next analyst in the discussion appears to be even more positive. On Tuesday morning, Palantir's share price jumped sharply after the company reported financial results that dealt a heavy blow to short sellers betting against the stock. This surge was fueled in part by comments from CNBC's Jim Cramer, who argued that the stock is dramatically undervalued. According to Cramer, Palantir will eventually reach $200 per share. He admitted that the exact timing is uncertain, whether it happens in the coming days or takes a bit longer, but he expressed confidence that the move is inevitable. A price of $200 would represent nearly 25% upside from the company's closing price of about $160.66 on Monday before the report was released. Cramer stressed that Palantir should not be judged strictly by traditional valuation metrics, which currently show the company trading at over 90 times estimated sales of $4,200 million for the next 12 months. Instead, he recommended using the Rule of 40, a measure that combines a company's revenue growth rate and its adjusted operating margin. Anything above 40 is considered a strong performance by this measure. Palantir's current score is 94, with revenue growing 48% and adjusted operating margins at 46%. The earnings report that drove the rally contained some record-breaking figures for the company. For the first time, Palantir reported a quarter with more than $1 billion in sales. Adjusted earnings per share came in at 16 cents, which is nearly 78% higher than the same period a year ago and ahead of analyst expectations. These results reinforce the narrative that the company's growth is accelerating and that it is benefiting heavily from the expansion of artificial intelligence applications. Despite these positive developments, not every voice in the analyst community is entirely bullish. Jonathan Weber, a highly ranked investor, recognized among the top 2% of stock analysts tracked by TipRanks, offered a more cautious take. While Weber acknowledged that Palantir's fundamentals are excellent and that the company has built significant momentum, he warned that its current valuation is extremely high. According to Weber, this makes the stock less appealing for new investors looking to enter at today's prices. Weber pointed out that Palantir's soaring revenue demonstrates that many customers find tremendous value in its technology. He also sees the possibility that the company's commercial segment could surpass its government business in revenue if the current pace of growth continues. This potential is being driven by the growing interest from United States businesses in adopting artificial intelligence to boost efficiency and enhance operations. However, Weber cautioned that the market is already pricing in very high expectations for future growth. He noted that no company can sustain a 100 times sales multiple forever, and at some point the valuation will likely adjust downward. While he remains impressed with Palantir's achievements and sees it as a strong investment for those who bought years ago, he does not believe that the current price represents good value. As a result, he assigned the stock a hold rating, meaning neutral, suggesting that investors neither rush to buy nor urgently sell at this stage. This measured view aligns with broader Wall Street sentiment. At present, Palantir has 7 hold ratings, compared with 4 buy ratings and 3 sell ratings, resulting in a consensus recommendation of hold. The average price target over the next 12 months is $116.17, which implies a potential downside of nearly 30% from the current trading levels. In summary, Palantir Technologies has drawn mixed reactions from analysts following its latest earnings, which included over $1 billion in quarterly sales, adjusted earnings per share of 16 cents, up nearly 78% year over year, and strong commercial momentum in the United States, with contract value surging over 222% to $843 million. Chris Versace raised his price target from $160 to $190, citing improved margins expected to reach 47% in the second half of 2025, while Jim Cramer predicted the stock will hit $200 based on the Rule of 40 score of 94. However, Jonathan Weber cautioned that the valuation is extremely high and could eventually decline, assigning a hold rating. Wall Street's consensus is also hold, with an average 12-month price target of $116.17, implying nearly 30% downside. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.